Hello, everyone. Happy Wise Wednesday. This is Charlene, Real Estate Rabbit, coming here to you. We're about to go live. I'm going to patch in Ray Harris with Ally First Home Bank, and we will be going ahead and starting to talk about our Talk About Tuesday questions. We'll be asking Ray about, well, you know what? Let me go ahead and add him in, and you guys, and he can start talking and you guys can start asking questions. I don't see anybody on here yet. I'm clearly by myself. Yeah, I'm going to go ahead and add him in so I won't be so lonely. So until you guys, hello, everyone. Hello. There is Ray. Let's bring him on camera. Hello, everyone joining in. Ray is on his way in. Looks like he's adding. And once he gets in, Ray.
What up?
Hello, can everyone hear me? Everyone out there can hi. Okay, so apparently everyone can hear me. Okay, so once again, you guys, I want to go ahead and just thank Ray for being on. He was on my Wise Wednesday about 2 weeks ago. Was it 2 weeks or 3 weeks ago?
I think 2 weeks.
2 weeks ago, I had some technical difficulties. I could not download the video, and first we couldn't get on Facebook Live together through my computer, and then I couldn't download the videos from Instagram because my phone wouldn't let me do it. My storage was acting crazy, and then it kept skipping. It was a whole bag of worms. So Ray gave so much great information that I wanted everyone on Facebook to hear it as well. So since it's documented on Facebook and it doesn't go away, this is why we're on Facebook today, so you guys won't miss that great information he gave on Instagram a couple of weeks ago. So I'm going to introduce Ray Harris. Great friend of mine, awesome loan originator. Go ahead and start, give your spiel and start your session.
Absolutely. So, like Charlene said, Ray Harris. I've been a mortgage loan originator. Started back in 2003, back in Baltimore in Maryland, where I went to school, and started back with the subprime loans. So, was offering people 6, 7% before the housing boom even started. So, I was doing loans before the first crash of our generation, and and saw the ups and downs of the market. So I've been a part of the market when it's ascending, when it's going up. Been a part of the market when it crashed and it's going down, and everybody was foreclosing and losing their home. So I've seen a lot of what goes on in the industry. I've seen a lot of change in everything that's gone on on the mortgage side of things, but also just on the real estate side of things as well. And right now, just looking at where we are economy wise, housing market wise, mortgage wise, it's an incredible time to be a home buyer. It's an incredible time to be an investor if that's a goal. Like, it's an incredible time to be in the market and really start to build on that long-term wealth. For most people, a buying a home is going to be the biggest investment in your life, right? Whether it's 100, 200, 300, whatever that price is going to be. Most people aren't investing that level of money into anything on any other channel except for real estate. And you can look and see that, like, 60, I think the number was 65% of the world's billionaires have made a lot of their money through real estate. Like, real estate is huge, and it's so much bigger than what people know. It's not a scary word. It's just something that you need to be educated on. You got to work with experts. You got to figure out people that are doing it and really learn what you need to know so that you can feel comfortable operating and having conversations and figuring out what you want to do. Is real estate investing something you want to do? Is buying a home something you want to do? And once you can get the knowledge, you can make an educated decision and really take care of yourself and even start to help friends and family as well.
Definitely. I always promote getting money and attaining generational wealth through real estate investments. My mom is a landlord and started buying properties when I was in high school. So I can attest to that. And there are ups and downs of being a landlord, yet at the same time, you have that option of then selling your property and you get money out of it. It's not like, you're buying cars and they're just depreciating in value, or, you're going on, on vacation. And yes, you get the valuable, memories of going on these vacations. Yet after you spend that money on that vacation, you gotta make more, to go to the
Yeah.
next one. And I always say that generational wealth through real estate investments or through investments regardless. Hey Tabitha. It's just always been number one for me and my friends and my family. And I've always said, if you can get an investment property, get an investment property. I actually have a group of friends who are doing the buy the block thing. So proud of,
Mm-hmm.
so proud of them. Um,
That's
but okay,
awesome.
so let's get into some of these talk about Tuesday questions, because the
All
reason
right.
I had you on the last time was because um, I feel as a benefit from you doing national loans, you have more of a idea of what the market is looking like, and you can bring different numbers that some local mortgage originators can't do. So explain a little bit about that, about what you do, and how it's a little bit, I'm not going to say more beneficial, but how it's beneficial for you to have access to these national loans.
Absolutely. So, not only being able to work on the local level, but being able to work on the national level with a smaller company, I'm able to find the best deals for borrowers. I'm able to find programs. So if there's a program out there, I just have to find an investor, which is just one of the mortgage companies that's willing to do it, right? Where I've worked at banks, I've worked at the big banks, and the popular ones everybody knows about, and it's like their guidelines are their guidelines. Nothing's wrong with that, but there's just no flexibility.
Right, right, right.
Where when I have people, I have the flexibility. If it's rate we're looking for, I can find the lowest rates in the market. If we need some specialty type programs, some different income type programs, self-employed borrowers, like I find the investors that can take care of those borrowers and figure it out. If it's credit score, like we can find companies that go down to as low as 500 credit score. So, working as a broker allows me the flexibility to help more people because I have the latitude and the flexibility to do so.
So here's something I thought was interesting that you said last time, which for me, I know I just recently sent a client to you, which I felt that they could be beneficial for this program. You have programs where, let's say you have lower credit scores, they go off of other things. Explain it to me. You were telling me about
So,
his tax accountant next time. I want everybody to hear about that, because a lot of real estate agents, because we spend so much on our business, it looks like we don't make a lot. So
yep.
explain that to me and explain that to my viewers.
Yeah, so, investors, i.e., the mortgage companies, they're just investors, right? They're just investors on a larger scale.
Right.
And so they're going to look for a couple of compensating factors, right? So if you don't have the high credit, so let's say a 510 credit score. All right, well now they're going to want to see, all right, if you don't have the credit, they're going to want to see that you have the income, right? So you're going to have to buy something that's not maxing you out as far as your finances. They're going to want to see a lot of times they're going to want to see some non-credit or non-traditional bills and make sure you've been on time with like your electric bill, with your light bill. They're going to want to see those type of things to say, all right, can this person actually make payments on time? Now, if you got a low credit score and you're not paying your utility bills, like I'm probably not going to be able to find you a mortgage because they're going to say this person's not going to pay their mortgage.
Right,
But,
right,
doesn't eliminate you if you make the money, if you got some assets, you got some compensating factors that an investor is going to look for. If you're a real estate agent, let's say you have the credit, but you don't have a tax return that shows the $100,000 or $200,000 that you actually make,
right,
because you got the payoffs, you got the expenses. Like obviously, you use those write-offs to make sure that you keep as much of your money in your pocket at the end of the year.
right. You gotta make
So
you gotta
as mortgage
make more
companies,
money.
yeah, they was trying to get you.
Right, right, right.
So mortgage companies know that. And so we have some aggressive investors that'll say, all right, well, we don't have it on the tax returns. Give me 12 months of bank statements showing cash flow. And they'll base your income off the cash flow of your bank statements versus what your tax returns show, because you don't get a paycheck or a W-2. So, I mean, if it's not your tax returns, if we see cash flow and we see money coming in consistently, they're going to take into account what you're bringing in consistently versus what the adjusted gross income of your tax returns is. So, a lot of different options for different people. We just got to make sure that we can check at least a couple of the boxes to get you the loan.
Definitely, definitely. Okay, all righty. So I'm gonna move into if I think of some more questions of what our last well, not questions, but more topics of what our last live was, I'll bring it up. But I'm gonna get into
Okay.
the questions that you got to talk about Tuesday, okay?
All right, let's do it.
All righty. So we talked about the benefit of national loans, and so this is before we get into talk about Tuesday. The national loans you do, we know that you have you know you give a lot of options with that. Tell
Hmm.
me, do you still handle local programs, because there's a lot of community programs, city programs, there's CHAPS in Baltimore, as far as you getting the rehab homes, there's here we had neighborhood lifts, like do you still work with those, or is that something that's no?
Yeah, absolutely. I still work with those as well. I just have to obviously find which program works, because they have different jurisdictions of where they work and what investors they work with, and then make sure that I have the opportunity to put that loan together for people. But absolutely, we can do those local programs, especially those down payment assistance programs that help people get into their home and with a low amount of money down or zero money down in some cases. So yeah, I can do the national programs, but I can also go to those local programs that have some of those down payment assistance and different pieces that help people get into especially their first home.
Okay, that's great. That's great. That's awesome. Well, that's the one thing I wanted people to know, is that you don't only do like, oh, it has to be this random from wherever. Like you actually do the local program that they're familiar with. Everything that a local lender can do, you can do, correct?
Absolutely.
Right? And more. Alrighty. So that was my other question. Okay. So hi. You want to be on my live? Sorry, guys, I was interrupted by my productivity coach. So next question is going to be, and this is actually, I get this from a lot of people, because there's a lot of new bills coming up in PG County. There's a lot of new bills coming up in Moco. There's a lot of new bills coming up in Charles County. Everywhere in Maryland, there are new bills everywhere you look. When you come
Hmm.
to a build, you often see that that the builders have linked up with mortgage companies. Do you have to
Hmm.
use those lenders that they have at the new builds?
No. So first and foremost,
But I think that you do, don't
they do.
they? Do.
And two things that I tell people right away, because one of the big myths is that like you don't need a real estate agent when you're going to buy a new build, right?
Mm.
So what happens is if you don't have your own real estate agent, you don't have anybody that's looking out for your best interest. So now everybody you're working with is working with the builder. So of course they're going to sway you to the most advantageous thing for the builder, not for you, right? So you want to have your real estate agent. Another little known fact is, as a buyer, you don't pay for your real estate agent. Like the builder or the seller, wherever that is, they're the ones that actually cover the cost of your agent. So you getting an agent is,
And
I mean,
that's why they
it's
have one, because they don't want to. They want that money in their
right. They
pocket.
don't want to pay that extra money
Right,
if they can
right,
cut some of
right.
those fees down. But it never hurts you to have a real estate agent, especially as a buyer, because now you have somebody looking out for your best interest. You have somebody that understands real estate contracts, that understand what's going on and can tell you the truth and the myths behind what those contracts say. Because some of those contracts are going to tell you you got to use this lender, you got to go with this person, but it's actually illegal for any seller to tell you you have to go to this company,
Yes.
right? Like as a buyer, you have the right to go to any mortgage company you want to purchase your home. They cannot tell you you have to go to a certain company unless you sign a contract that says you will go with that company.
Right.
Which is why you need your real estate agent that goes, like, nope, take that line out. Like,
Right.
we're
And
not signing up for that.
because you may lock yourself into some things you don't want to get locked into.
Exactly. Like, nobody wants to read a 30-page real estate contract except for your realtor.
Especially when they
Like,
do it every day. You have no idea what they're talking about.
exactly. So, bottom line is, yes, you can choose whoever you want as an agent or as a mortgage lender, but I would also highly recommend you have your own real estate agent going in on it with you, because they can let you know the ins and outs so that you don't get yourself locked into something that you actually don't want to do at the end of the day.
Very, very true. Very true. Okay, so second question, thank you, Ray, is going to be, you already talked about some of the lower scores that you can deal with. Hi, Carmen. Some of the low. So what is the lowest score right now for the loans that you deal with? What is the lowest score that you will possibly take and that will get approved?
500.
500, which is a lot better than what some other companies will do. Not only that, and I want to make this point. I have some clients that come to me for rentals. And then when they come to me for rentals, they have scores in the fives, or maybe they have a 600 score. If your score is 600 and you have okay income, I don't think you should be renting. I mean, everybody rents
Right.
for a reason. It could be that you want the amenities of what it's giving. That's literally the only option I could think of for renting, is that you want the amenities of where you're living. Other than
Right.
you should be looking into investing in yourself and in your future. So let's see. So for in loans, we talked about that. Next, so we were just talking about this with the low credit. I have a lot of clients that feel like, I don't want to do credit repair because it's not going to make a difference. It's not going to be fast enough. I'm going to be, doing this forever, and all I'm doing is paying money and nothing's going to happen from it. How do you feel about credit repair programs? And I know, because you work with clients who've done them. How fast have you seen results, and what can you tell me about them?
So it's another one of those things where you got to be careful who you go to, right? You want to work with people that come highly recommended from somebody else.
Yes, like
Right.
me.
Right, exactly. So again, you have an agent on your side. You want people that are being referred by other people, because typically it means they've worked with them before.
Yes.
So there are some really good credit repair agencies, and there are some really bad credit repair agencies.
Yes.
And so when you go in to look at it, that doesn't mean you have to sign up to do it. Like, again, it's a great time, especially if you have a real estate agent or a mortgage lender that you're working with. Before you sign paperwork, like, send the paperwork or review the paperwork with your real estate agent or your mortgage lender, so that they can see, hey, this isn't going to actually help your credit. Like, this isn't getting us to our goal.
Right.
Or this is perfect. Like, because in general, it works, but credit score up. So I would say it can be a good thing in the right situation. It's not going to work for everybody, but again, you got to make sure you have somebody looking at that contract with you, so that you know that it's actually doing what you want it to do. Because sometimes they're repairing your credit, but it's a 5-year process. Like, that's not what most people are looking for when they're like, I want to buy a home in a year. Well, a 5-year process isn't going to help you buy a home in a year. So
Right.
you got to make sure you know your options, and you got to make sure you're with somebody that can help you review these things to know what's really good and what's not.
Definitely. Okay, so that's straight from the man with the plan, who gets you to the point where you need to get into your home, letting you know about the credit repair. You want to, first of all, check and make sure you need this room. Okay. You want to check and make sure that you're going with a trusted source. You also want to look into it and make sure that it's on your time frame to go ahead and get your plans and your goals into processing into works. I'm sorry, guys. My brokerage is crazy today. We have been fighting for rooms. So if you guys see that keep coming in or you see me interrupting, it's because I'm actually being kicked out of this room right now because meetings are over running and all the other stuff. So excuse me for the breakups and for the delays and for the interruptions. So tell me, what are some of the most common types of loans?
So the three that you'll hear the most about are the conventional loan. So those are the loans that are backed by Fannie Mae and Freddie Mac,
Okay.
right? Then you have your FHA, which is a government-sponsored program for it's another low down payment option, and then there's VA, which is for veterans. I would
Yes.
say probably 70% of the loans go through those three programs that I've seen.
Okay. And so what's the difference between an FHA loan and a conventional loan?
The biggest differences are FHA is going to be a lot more credit friendly as far as people with lower credit scores. They're going to be a lot more friendly with people with lower down payments and different things. Like if you have credit issues, FHA is probably going to be a better route for you. Conventional is a lot more cut and dry. There's not a lot of leeway in the conventional market. Like they want no lower than a 620 score. You know, they don't want bankruptcies, they don't want foreclosures, they don't want collections, any of that.
Okay, understandable. So so like in layman's term, an FHA would be like, so no. So in layman's term, a conventional would be more like a private loan.
No, it's still not private. It's just backed by a different investor. So FHA and VA are government programs. So they're a little they just have more leeway. Conventional is going to be more of a strict loan as far as the guidelines we have to follow. But if you have good credit, you have good income, conventional is probably the way to go because in a lot of instances the pricing and things are going to be a little better on the conventional side.
Okay. So as far as, let's see, we've got the most commons. Because I get this from my new buyers, my first time buyers, origination fee. Can you hear me?
Yes, yeah, I can hear you. So origination fee. So what an origination fee overall is that's the lender's fee for doing your loan, right? So different lenders are going to have different origination fees. They're not illegal fees. They're not ripping you off in most cases. It's just that company's fee. Not every company has to charge an origination fee. But so that's just usually the lender's fee for doing the loan. An origination fee can show one of two ways. It can either be, you're kind of breaking up, what'd you say?
Can you hear me?
Well, I started losing you.
Yeah, I just started acting up. Can you now? Okay.
Yep.
Better. Continue.
All right, what was your question?
Hello? Can you hear me? Can you hear me?
I can. I think it's delayed though.
Yep. It is. Okay.
Can you hear me?
Is it still delayed? I can hear you fine.
All right, then we're good. I can hear you now.
Okay, good. All righty. So you were talking about it's just basically the fee that the mortgage, that you pay to the mortgage company for processing and handling and doing their job, right? Okay. Not a ripoff. Not something that people need to be appalled about, right?
Well, depending on the fee.
Oh.
So like.
Okay.
Yeah. So now you got to be careful. It's another place where you want to pay attention because origination fee and discount point can be interchanged, right?
That's what I was going to.
And so
discount point.
Yep. So a discount point is the charge or credit for the rate, right? So the higher the rate, the better chance you should be getting a credit that you can use towards your closing costs, which is like title fees, lender fees, escrow, like all of those things. And escrow is just your taxes and insurance that are included in your payment. So you can, if you take a higher rate, you can a lot of times get a credit back to help you cover some costs.
Okay.
But the lower the rate you get, the better chance that you're actually going to be paying for the rate, or it's just going to be what's called par, which is just you're not paying or getting a credit back. So what I'd say is most people, if you can avoid paying points, you want to avoid points.
Okay.
But
I've heard that before now. And points are explain how points work as far as when you're sitting at the closing table and when it comes to your mortgage, because are points included in your mortgage?
most of the time on a purchase, no, they're never included in your mortgage. They're always paid at closing. Unless you get some kind of seller credit, then it might be covered in a credit. But outside of that, you would be paying points as part of your closing costs when you bring your cash to close.
There we go. All righty. So next question, because we got origination and we got points. Our next question is going to be, you guys, multitasking. Bear with me. How about, I already asked about lender on a new build. That's it for our Talk About Tuesday question. Oh, wait, I got one more in the back. I'm sorry. Okay, that was another question. So I suppose I have some military people watching. Hello, military people. As far as VA loans, are the rates always the same with every single lender, like across the board? Or can you get a better rate from from different lenders?
Yeah, with VA loans, you can get different rates with different lenders. It's the same thing like I was talking about. We work with a number of different investors, and each investor has a different rate for their VA loans. So it's just like the FHA or the conventional, where depending on the investor, depending on the credit score, depending on the down payment if you're purchasing, or the loan to value if you're refinancing, those are all going to factor into what the rate's going to be. And then which investors have the best pricing is going to be the determining factor. So you can talk to 5 different VA companies and have 5 different rates.
Okay. Well, I see a question in here from Kelly. Hi, Kelly. Kelly is actually another realtor. Kelly is a realtor in Chicago. So anyone in Chicago, I am supposed to recommend a Keller Williams realtor. Yeah, Kelly is one of my very best, very, very best friends. And she is the best in real estate as well. So a question from Chicago. She wants us to talk about FHA loans. So give me a little something about FHA loans and give me some tips and let me know about those, or let us know about those.
Yeah, so hi Kelly, how you doing out there in Chicago? It's probably cold out there, but gotta be all right. But FHA loans, like I said, it's a government-sponsored program. It's a great program for people that don't have a lot of money for a down payment, don't have great credit, and need to get into a house. Like FHA is where we can go down to 500 on a purchase, credit score wise. 3.5% is the mandatory FHA, but you can get some down payment assistance programs that actually help with FHA loans, which is awesome. That FHA allows those down payment assistance programs. It's a great program for certain people. The biggest thing that I see is that sometimes people get put into an FHA loan when they don't need to. If you have good credit and you have down payment, you probably shouldn't be in an FHA loan unless there's something funny going on, like a manufactured house or a foreclosure or bankruptcy that happened in the past, because FHA is just really lenient on those things to allow some other people in the house. So you definitely want to make sure that you're getting into the right loan, because I could go on for days about the differences between FHA and VA and conventional. Each and every one has its place depending on the borrower. You just want to make sure that you understand why you're being put in a particular loan, because while FHA has some great characteristics, there are also some negatives, like mortgage insurance, right? Mortgage insurance is going to be the highest on an FHA loan than it is on a conventional loan. And then, if you're a veteran, a VA loan, there is no mortgage insurance. So there's just those little pieces that you need to understand, and at least understand why you're being put in certain loans, because there's benefits to each, but there's also, the other side where there's some drawbacks to each loan that you just have to understand which one is going to be best for you and which ones you qualify for.
Right. So you just brought up something that made me, this is one of my questions last time that I forgot to ask, and I'm glad you said it because I was going to forget it again this time. Mortgage insurance. What is mortgage insurance?
So mortgage insurance for the buyer is just an extra cost, right? And the reason being is for an FHA loan, again, Federal Housing Administration, it's a government-backed entity. So you pay mortgage insurance to guarantee the loan. So all they're really doing is, if you stop paying your mortgage and default on the loan, if you have an FHA loan, FHA actually covers a lot of the costs for the lender that you went with. For conventional loans, you're going to go with private mortgage insurance. Same thing. It's just insurance to protect the lender in case you default.
Got you.
So, and it's additional. It doesn't benefit you in any way, but you are required to pay it if you're not in a conventional loan or VA loan. With conventional, there's some ways around it, some different options as far as doing a first and a second mortgage, things like that. We can go into that stuff later. I don't want to confuse people, but there are some options around mortgage insurance. But typically, if you're putting less than 20% down and you're not in a VA loan, you're going to have some type of mortgage insurance.
So give me a number really quick, like some numbers. Let's say you have a VA loan and you're not putting, oh no, I'm sorry. Let's say you're, I totally, my mind, sorry. I'm sorry. So I was saying, let's put some numbers to it. So you said if you're not putting down, what was the percentage you said you had to put down in order to not have mortgage insurance?
20%.
20%. So let's say I'm buying a $250,000 home. I would need to put down what amount for that?
$50,000.
$50,000. So if you are not putting down at least $50,000 on a home, or on a $250,000 home, you need to have, you're gonna be required to have mortgage insurance.
Okay. Correct.
Got you. Hello, Erica. How are you? So that's good to know. As far as down payment, now it's for every loan. Is the down payment going to be the same? Like, how does that work as far as the percentage that they need to have for down payments? Are all programs the same? Some higher, some lower? How does that work?
So VA, you can borrow 100% of the purchase price. So you don't actually have to have a down payment if you don't want one. Mm-hmm. FHA, minimum of 3.5%. Whether you get down payment assistance or not, you got to get 3.5% down payment. Mm-hmm. And then conventional, we have some conventional loans that go down to 3%, but the most normal that you're going to hear every day is a 5% down on the conventional loans. Okay.
Yeah, that's normally what I hear is the 5%. People always want to get prepared with 5%. And that's always what I tell people to try to get prepared with and saving up for. So I'm done with the Talk About Tuesday questions. Do you have some tips to give to my viewers? Or I know last time I let you talk and you had some awesome information. And this time it's a little different because I'm on the move. Yet that's why I have you on here, because I want you to be able to spread your knowledge like you did last time. So I am going to just let you go, because you hit it last time. You gave us some jewels.
Yeah, I mean, I would say first things first is you want to get all your ducks in a row. So you gotta get your people on your side, right? Like, you gotta have your realtor, somebody that you trust, somebody that you believe is going to be out for your best interest, right? And then you want to find a mortgage lender. You you don't just because you talk to a mortgage lender doesn't mean they're pulling your credit or you're locked into whatever programs they talk about or whatever rates they talk about. But you want to get an idea of where you stand, right? You got to know.
Thank you, Kelly.
What kind of options you have. You have to understand like what you're looking at before you go start looking at houses. So I think we talked about this before. The two things that you need to know is what you qualify for. So you're going to get that from a mortgage lender. I mean, I know a lot of real estate agents here in Arizona that typically won't do much outside of just sitting down and getting some general information until you talk to a mortgage lender, because
that part,
you may not be able to buy a house and they're out there showing you houses that are for sale, and you should be going into the rental market. So you want to sit down, you want to have an idea of what some goals are. You got to understand how much money you make and how much money you can actually afford to spend. Because sometimes I can qualify you for a $500,000 house, but that doesn't necessarily mean you can afford a $500,000 house. Like, you got to understand your budget, you got to understand your money, and then you got to just know what you're qualified for, because then you have options. Once you have information, then you have options.
Yes, and that's key.
That's a big thing.
We actually can't go out until we get that pre-approval letter and know how much house you can buy. We really can't look for anything for you, because we're out here just pulling everything and going to everything, and that's not the way to find something else. That's the way to get everybody frustrated and not wanting to deal.
Absolutely.
So continue. Sorry, I just had to put my little 2 cents.
Oh, so wait, I see Kelly's question there.
Yeah, we got a question on income to debt ratio.
Yeah, so great point, Kelly. Debt, so we call it debt to income, or you might hear a mortgage lender say DTI, which is just debt to income, right? And that's how us as mortgage lenders figure out how much house you can afford or how much of a mortgage payment you can afford. And so what we're going to do is we're going to take all of your traditional debts. So these are going to be like car payments, credit cards, student loans, which is a big one. Other mortgages, you have other mortgages, anything that gets reported to credit.
Can I interject really quick for that when you said student loans? For student loans, you have to be paying on them, correct?
No. Well, depends on the program.
Okay.
So I have investors where you don't.
A whole nother bag of worms, so continue.
Right. So you don't necessarily have to be paying on it, but we are going to calculate the payment on most programs with the full payment of your student loans, if that makes sense. So let's say you have a $100,000 student loan and you're on an income repayment plan with the student loan. So they're charging you $50 a month, right? Well, if you go into an FHA loan, we are actually going to take 1% of that student loan, which is $1,000. So now you have to qualify for a house based on you paying $1,000 a month just for that student loan.
Okay.
And so your debt to income is going to be all the monthly payments. So it's not your total balance of your credit card, but it's what does the credit card minimum payment say?
Okay.
Right? Same thing with a car payment. It's not what you pay, it's what your minimum payment for the car is, which is typically just the monthly payment there. And so we're going to take all of those monthly payments, anything that reports to your credit report and is either revolving or an installment. Revolving just means that there's actually no designated end date to the payments, which is credit cards. Like they just want you to pay on credit cards forever. But that's a whole nother topic, where a car payment will be like 60 months or 72 months or 36 months, things like that. And so we're going to take all those payments and we're going to divide it by how much gross income you receive. So if you're W-2, that's before your taxes, before the health insurance, before all of those different things come out of your paycheck. We want to know what the gross is, and we'll use that to calculate your debt to income. And so for conventional, it's 50%. For FHA, sometimes it can go up to 55. And then even for our VA, it can go up to 60 and sometimes a little bit above with certain lenders that I have.
Okay. So with that, I want to touch on something I remember we talked about last time about the rule of three, the third rule. What is that rule as far as your credit card, as far as your credit card balance? What do you want to do for that?
So anything above 33% balance compared to your high balance or what your credit limit is going to typically be reported as negative debt. It means you're basically you're living off of your credit cards is how the credit companies view it. So when you're starting to look and say, all right, what do I need to do with my credit cards? Usually you want to have easiest math is if you have $1,000 credit limit, you want that you want your balance on your credit cards to be about $300 or less,
Okay.
right? That's going to get you to about 30% of your credit card. You're using 30% of your limit, which is considered good. Anything above that can, even though you're paying it on time, can still be looked at as negative.
And that's per credit card, correct? That's not
Per
across the
credit card.
board.
Each one is separate.
Each one is separate. All right. Just so you
Mm-hmm.
guys know, each one is separate. It is not across the board. Don't go out trying to get brand new credit cards because you want to go ahead and put down and make your balance lower because you think that the total balance is it's not the total balance.
Correct.
So with that, let's say that I have let's say I'm in good standing with my credit card company. Let's say I have a little bit of a higher balance. I'm at on $1,000 credit card. I'm at 500 and not my three. And
Mm-hmm.
I decide I want to buy a home. I find a home. I want to I'm balls to the wall. I want to get it now. And I know my credit is about to get run by a mortgage, by a loan officer. Would you suggest? I mean, what would you suggest? Because of course, suggest anything. We suggest the best things for our clients. How realistic is it that I can go ahead, call into my credit card company, and if I'm in good standing, ask for them to raise my balance?
It's very possible. I mean, it just again depends on your standing with the credit card company and your credit. They're going to look at your overall credit profile as well if they're going to raise your balance. But what most people don't take into account is if they raise your limit today, I think I said balance, I meant limit. If they raise your limit today, that doesn't mean your credit score goes up today.
Okay. Now, are they
So
pulling your credit when they raise your score?
not where it'll lower your credit score, no.
Okay.
Not if you already have the card with them.
Okay. Because I know these are
If you're
common
going for new
that I
credit,
get from
they'll pull your credit though.
credit. So
Yeah, so everything doesn't happen right away. Like if you pay off a credit card today, it's not going to be reflected in your credit score tomorrow. Like it takes time, 30, 60, 90, 120 days. So, a lot of times it's beneficial to see what your credit score is and to see whether you actually need to pay down debt or pay off debt before you go out and do it. Because it might be where we say, hey, your credit score is not going to change that much. Like you're at a 680, you might go up to a 690. That's not going to change your standing with getting the loan or your approval. Why don't you save that money and let's move that to a down payment, or let's use that for closing costs, or use that for your inspections and your appraisals and things like that. So you don't just want to go start trying to fix your credit on your own. Like actually have the credit pulled, because a lot of times I'll tell people like, I mean, if you want to pay it down, you can, but it's not going to change what we're doing with this mortgage. So then again, now you have options versus thinking you had to pay it down when it really didn't make a difference for your loan profile.
okay. So now I have another question for you. That brings up something that I literally just had this conversation with a client the other day. A lot of clients feel like, or not going to say a lot, there are some clients that feel like I don't have I have good credit, but I want to make my credit better so I can get a better rate, which a lot of the times is true, correct?
Yes.
Yeah,
depending on how much better you can make your credit.
that was my question. If I'm going for what would have to be the difference to make a big what would have to be the change to make a big difference in interest rate, hike, or an interest rate being lower?
Typically 20 to 40 points. There's different tiers for different companies. So, a 620 to I think a 660 in most of our companies, you're going to get about the same rate. A 660 to 700, you're going to get about the same rate. 700 to 740, you're going to get about the same rate.
He's no comedian.
And then 740 and above. But, I think Kelly just mentioned it. There's a lot of resources to learn about credit and not just go out. I mean, I know most cities or counties have free credit classes where you can go in and learn about credit for free.
Yep.
You just got to be able to go use those resources. A lot of the first-time home seminars have all of that. So again, you got to use your resources and get with the people that can explain to you what's going on with your credit, what's going on with your credit cards, your debts, all of those things, because you just want to get the information and not just think you're going to do it on your own, because that's not going to work most of the time, because you just don't understand the processes and what a mortgage company looks at, because it's different than what a car company might look at or a credit card company might look at.
Right. And that's a large thing. A lot of people that come to me feel like, I know I got, my credit was this, and I got approved, but it's totally different from a house. I had another lender tell me that sometimes your scores on Credit Karma means nothing. Like, it gives you a good idea, but not really.
Yeah, it's always higher. Credit Karma always gives higher rates than when we pull it. If you tell me your Credit Karma score, I automatically take it 30 points down.
Ooh, okay. Well, food for thought, you guys. Take heed to Credit Karma, but also always talk to a mortgage lender before you start looking for a home. Definitely guarantee, looking for a realtor. Yet, if you don't know a lender, your realtor can give you a lender. Most of the time, if you don't know a realtor, your lender can give you a realtor. That's just how it works all the time. All right, so how do you consider? I have a question. How do you consider who is the best mortgage lender to go with?
I mean, what I would say is overall, you want to go with someone that has the programs that you need, obviously, but also someone that's going to explain the process to you, someone that's knowledgeable and understands and takes the time to explain it so that you understand it, and somebody that you feel like you trust, right? You gotta trust the person you're working with, or else it's gonna be an awful experience if you don't trust that person, because you're gonna question everything they say. You're not gonna feel comfortable. You're gonna be nervous. You're gonna be anxious, and it's just gonna be a tough process. So you want to trust the person you're with, and you want to make sure that they have programs that fit your need and that they're actually tailoring what they work up for you based on your needs and not what they tell you you need.
Okay, so that is how, and you're gonna want to, like you said, you guys are want to go with someone that you trust. And since you guys are on my live, we know that you already trust me. So I'm the best realtor for you, of course, and I'm always gonna use my trusted sources, and lead my clients in the best possible, to get the best possible deal, the fastest, and be satisfied at the end of the day with the transaction, because it can be, it's a lot of people are going through this the first time. We really don't know what's going on, and so trust is a big factor. Let's see, what other tips do you have for us about maybe the first time home buying process, or I got my room back, guys. Or the first time that's, or maybe just some mortgage tips, loan tips, that can help my viewers before we wrap up.
Yeah, I mean, my number one tip, honestly, so that I can keep it general, is the two things you want to do is talk to a realtor. So especially if you're in the DMV, you hit up Charlene, sit down with her, like go over your goals, go over what you want to do, and get in contact with a lender. It doesn't automatically mean they're going to pull your credit, but they can sit down and have those conversations with you and just at least give you the information you need to feel comfortable about making a decision on whether you want to purchase a home or you want to rent, or the rent to own, all these different options. Sit down with the professionals, get the information that you need, and it'll better equip you to feel comfortable in the process, and it'll give you the options that you need to be able to make the best decision for you and your family. I would say that's the number one tip I can give you, is get with the professionals and know the information.
Yes, that is very, 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 very important. Most of the conversations that I have with people that contact me the first time is anybody who you speak with, whatever realtor you speak with, whatever lender you're speaking with, they're doing something called pre-qualifying you. Now, that has nothing to do with your credit. It has nothing to do with anything. What a pre-qualify is they're trying to see where you are in life. We're trying to figure out whether you're ready now, you're ready in a couple of months, you're ready next year, or whether we need to sit down and have a plan. And anytime I have a client, I always say, reach out to, if you don't have a lender, I have, a great lender that I can refer you to. Let them let you know where they are, where you are, and then we can talk. A lot of people don't want to do that because they're scared to speak to a lender. So they rely on me to tell them what's going on, and I really can't. And then when they feel like they're not ready, or they say to me like, oh, I know I want to buy, yet I think I have bad credit. It really helps to speak with the lender so that my plan can be better for you. Because that's what I'm going to do at the end of the day. If you're not ready right now for your credit, with your credit, or with whatever situation you're going through, I am not just a fly-by-night realtor. Like, and you're not a fly-by-night mortgage lender at all.
Right.
We're here for the long haul. Once you begin to speak with us, contract or no contract, I take my clients on as a portion of my life and as my family. This is my job. This is what I do. This is what I love to do. That's not my job. This is my career, and this is my life. Real estate life is real. Mortgage life is real. Like, there's some things that we go through with our clients, bring you closer. There's some people that you never knew in life than you would be it was somebody who's a church member or a family member. Like, this is real stuff. So never ever be scared to be honest with who you're working with, because not only do we hear this all the time, you know how it is, Adrian. We begin here having church sometimes with our clients because of what goes on. But never be scared to talk to your realtor. We're trusted. We're your fiduciary resource. Use us, talk to us. Never be scared. Never be scared to talk to your lender. There is no situation we haven't seen or heard. Do you hear me? There's no situation we have not seen, heard, or possibly been in, because we're all human. So never be scared to talk about what your situation is, because the whole point is, even if you're not ready right now, the point is to have a plan. And realtors, good lenders, good financial advisors are going to give you a plan to get you to where you want to be. And a lot of times people who don't have good credit can't afford, hey, Greg, how are you? Can't afford to have a financial planner. So that's where we fall in line, because we actually